and welcome. I am Levin Lane, Economics and Financial Policy Reporter at The Hill. Thank you for joining us for our program today, Principled Profit, The Hill's ESG Summit. Before we begin, I'd like to thank our sponsor, Schneider Electric, for their support of today's event. Environmental, social, and corporate governance, or ESG investing, is the increasingly popular inclination of investors to make capital decisions based not only on likely financial return, but also with an eye toward investing in companies perceived to be creating social good. Earlier this year, the Securities and Exchange Commission proposed 2 rule changes that would prevent misleading or deceptive claims by U.S. funds on their ESG qualifications and increase disclosure requirements for those funds. The proposals come amid mounting concerns that some funds seeking to profit from the rise in ESG investing practices have misled shareholders over what's in their holdings, a practice known as greenwashing. Our show today will delve into the new SEC rules, the growing demand of ESG, and how it's transforming the business and investment landscape. But before we get underway, a few housekeeping notes. You can tweet us at The Hill Events using the hashtag TheHillESG. We are broadcasting live, and we will be taking your questions throughout the program. My first guest today is Congressman Andy Levin, a Democrat from Michigan and a member of the House Education and Labor Committee. Congressman Levin, thanks so much for joining us.
Hey, Sylvan, thanks for having me, and I'm so glad you're doing this.
Of course. So I want to launch in with, kind of a general question about the whole point of ESG investing. And, from your perspective, what do ESG investment funds or opportunities bring in terms of opportunities for investors to make a difference?
Well, the potential is just huge. ESG investments have been growing. In 2021, ESG-focused exchange-traded funds rose on a global basis by 53% to $2.7 trillion. So why is this happening? What does it bring? And basically, I think that working people, particularly younger ones who have pensions, who have 401ks, other investors, they want to invest their values to promote a more sustainable planet, workers' rights, good corporate governance. And we've seen that investing in the ESG way doesn't mean a loss of returns, quite the opposite. Numerous studies have shown that sustainable investing yields returns comparable to or greater than traditional investing. And I think it's really important, Sylvan, not just to sort of give people what they want, but to get more young people in the game. We know there's a huge problem in this country of people not saving enough for their retirement, and especially not starting when they're young enough. And if people can begin investing in saying, wow, I want to move this world to carbon neutrality. I want to make sure there aren't human rights violations in the supply chain of what I'm buying or what I'm investing in, then I think they can make a real difference in how our economy works. And also, it's really important that they save for their retirement. So I want to motivate them to get in the game.
Now, Congressman, you mentioned quite a few different issues that kind of cover the whole umbrella of ESG. And I was wondering, from your perspective as a policymaker, why do you think there's been such an increase in interest in ESG funds and investment opportunities?
Well, I think a couple reasons. One, there's no longer really any room for debate about the overheating of this planet. It is a 5-alarm emergency. We've got to change everything about the way we move about this planet, we live on it, our buildings, our manufacturing, our transportation, our land use, our forests, agriculture, everything. And so investing's got to be a big part of that. So I think that is one big factor. And secondly, on a broader basis, I think the emerging, generation of young adults really feels like, hey, I want everything I do to reflect my values. And I think that's a big driver of it. So it's about climate change, but it's about something broader than that, that they want their money that they put into saving for their retirement to be clean, to reflect their values in the world, whether they're religious or humanist, it really doesn't matter, right? It's about people feeling like they can be true to themselves and their vision for the world.
Now, Congressman, when it comes to being able to be true to themselves and their vision for the world, obviously investors are wading through this new world without necessarily a super clear idea of what they're getting into. Do you think that folks interested in investing in ESG have enough information and enough clarity to be able to determine where their money is actually going and whether it's making the difference that they want to make?
Well, I think we have a lot more work to do there. So there are some opportunities, but I've introduced legislation about this because I think it's important that we do more work. So I have two bills because they govern, different areas of the investment landscape. One is the Sustainable Investment Policies Act, which regulates independent investment advisors, and the other is the Retirees Sustainable Investment Opportunities Act that governs your ERISA. And as you mentioned, I'm on the Education Labor Committee and the Help Subcommittee, which has jurisdiction there. So that's why I'm so interested in this. And what we have to do is say that we want plans to offer ESG options. We want there to be clarity about some guardrails. So we can't have this greenwashing. We can't have these phony claims. We have to have some standards. I'm glad the SEC is stepping up, like with its investigation of Goldman Sachs and so forth. But I think that Congress should also act to provide legislation to put a framework around this so that investors can really have confidence that their ESG investments are doing what they say they're doing.
When it comes to developing that confidence too, we just talked a little bit about the SEC regulations that have been proposed to try to bring some clarity to this space. I was wondering if you thought the SEC was moving in the right direction and if there's anything more that they should be doing to kind of increase transparency and help folks get a better handle on ESG investments.
Well, I think they are moving in the right direction, but this has been an area, we can't just allow empty claims here. We need real transparency in supply chains, in sourcing of materials, in the factories around the world that companies may be using to produce goods, in their raw materials. And there are a lot of advances going on in this regard, but there's also a great amount of opportunity for people not being truthful or honest or forthcoming about it. So I think it's very important that the SEC act. And as I say, I think it's also important for us to act in Congress so that we encourage more of this at the same time that we give investors confidence that when they make an ESG investment, that it really is advancing their values instead of just making money for a fund that is, trying to capture people's interest without really delivering the goods they're looking for.
Now, Congressman, I know I don't need to tell you, but there is, considerable political concern among some of your Republican colleagues about ESG investing proposals and disclosure in general. Just in terms of whether or not companies should be focused on these issues and whether or not it's appropriate for financial regulators to lay out what kinds of information in terms of ESG-related issues companies should be laying out. And I was wondering if you think it's possible for businesses to both focus on profits while also putting out information about ESG that might align with some of these broader societal goals.
Well, Sylvan, I'm telling you, I think this is real bottom line stuff here. It's not just feel good or, something about somebody's morality that's not based in economics. If you have fundamental, child labor in your supply chain, that's going to come back to bite you. And I, as an investor, am going to be harmed by that. And especially on environmental sustainability, people have a right to know that they're investing in companies that are going to be profitable as we move into a carbon-free economy. And I think the SEC and other regulators are duty-bound at this point in the climate change emergency to give investors as much information as they can, so everyday folks can invest their money and not have it come back to bite them 10 years down the road when they've invested in a company that's really not sustainable, and their investment performs poorly because they lacked information they should have had access to. So I think this is very practical and very important for making sure that people can realize the returns they want, in addition to reflecting their values.
Now, Congressman, you mentioned a little bit about what can happen to a company if it's not equipped for the climate change that we've seen so far, but there's also an issue of so-called transition risk. What happens to the financial system as the world on whole starts to move more toward carbon neutral sources of fuel? And I was wondering if you think the U.S. financial system, as it stands right now, is equipped to handle these types of changes based on the amount of information we're getting from companies under the current regulatory regime?
Well, I mean, one good thing, I worry about it a lot, Sylvan. One good thing is that the banks and other financial entities have an interest in getting this right. But I think we need to have a lot more oversight over this, and we have to do a lot more work, both the regulatory agencies and Congress, to figure out how we can make this transition smoothly, or as smoothly as possible, so that it becomes an engine of economic growth and prosperity rather than having people get hurt. And if people do get hurt, almost inevitably, the people who get hurt the most are poor people, people of color, people who have the least access to information or the least power in investment markets. So I'm very keen on this transition being a just transition, even in this financial aspect of things, and investment aspect.
Congressman, my last question for you. We've talked a lot about the public sector and what the government should be doing, but I wanted to ask you too, what if you've been happy with how companies have responded so far to the growing push for ESG, and if there's anything else you would like to see companies take up on their own instead of having the government have to come in with regulations and rules to make that happen?
Well, I personally don't think that there is a big contradiction between strong and clear policies and vibrant capitalism. And so I think that, strong and clear policies are actually good. But what I would say to the companies is, as just a regular person who watches, when companies develop very strong sustainability policies and real transparency, and they show all the information to their investors and other stakeholders, it really makes a difference, and you can tell. So I'm in favor of more strong policy to help this developing area continue to grow. But I would encourage companies to focus on this, to invest in it, and to treat it as a matter of integrity, just as important as you do your bookkeeping or other areas that you've got to get right. Because this is something that investors are not going to turn away from. It's going to be really important for the health of your company going forward.
Congressman Andy Levin, Democrat from Michigan, thank you so much for your time today.
Thanks, Sylvan. Good luck with your event.
It's now time for the sponsor perspective portion of the program. Please welcome Annette Clayton, the Chief Executive Officer of Schneider Electric North America.
Thank you for joining us today. My name is Annette Clayton, and I welcome the opportunity to share Schneider Electric's perspective on ESG. We're deeply invested in this conversation because it's a core part of our business strategy. We distribute reliable energy safely from the grid to the plug, and our products are found in 4 out of 10 American homes, 70% of buildings, and 50% of hospitals around the world. We're the largest corporate advisor on renewable energy purchasing in the country, and we're also the leading builder of microgrids in the U.S. with over 300 installations. As an impact company, sustainability is embedded in every decision we make, and we're not alone. Part of the reason for that is investors, customers, and employees increasingly demand strong ESG operating principles as they're good for business. Take decarbonization, for example. Most businesses today, less carbon means less cost. It's not a partisan issue, it's just basic math, and it's a huge opportunity. At Schneider Electric, we're helping companies deliver on their climate pledges while reducing costs and improving efficiency at the same time. Our approach centers on 3 key steps. It starts with reducing energy waste. That's important because the U.S. wasted 62% of all the energy generated in 2020. The second step is replacing fossil fuels with zero carbon sources for the energy you use. And finally, engaging your value chain is critical because no one decarbonizes alone. And supply chain emissions are 11 times higher than operational emissions on average. Reduce, replace, engage, that's the path we're taking toward our goal of becoming carbon neutral by 2025. And it's a roadmap that anyone can follow. We've found transparency and accountability are the biggest keys to success. We tell customers to align their ESG targets with the industry-leading standards, share them with the public, and publish regular updates on their progress. That's how climate pledges become climate leadership. We also see a role for the government to play because we need to accelerate investments in digitization across the energy ecosystem. Modernizing our infrastructure and removing barriers to public-private partnerships can also help deploy more clean energy. Everything we do at Schneider Electric is about making the places we live and work smarter, safer, and healthier for people and the planet. Case in point, we've installed a microgrid in the nation's second busiest port, the Port of Long Beach, to electrify it, bolster its energy resilience, and ensure business continuity. We're doing the same in the new terminal at JFK, where we're working to improve the sustainability of the terminal and enhance the reliability of the airport's energy supply. And just outside of DC, we're working with Montgomery County to build microgrids to power critical county facilities with zero upfront cost to taxpayers. And they'll soon open a new electric public bus terminal that's going to be one of the largest in the nation. It'll be more reliable during severe weather events, and it will be powered by 100% renewable energy that will cut emissions by more than 60%. Those examples are just a few reasons why I'm so excited about the federal infrastructure investments that have been made by our leaders in Washington and about the ESG conversation that continue to take place in boardrooms all across the country. We're on the cusp of an all-electric future. The technology that we need to make this happen exists today, and it'll make our world more sustainable. It will also make our nation more energy independent, more resilient, and more secure. Thank you, and please enjoy the rest of your program.
Thanks again to Annette Clayton, the Chief Executive Officer of Schneider Electric North America, for your support of today's program. My next guest today is Savita Subramanian, Head of U.S. Equity and Quantitative Strategy and Head of Environmental and Social Governance Research at the Bank of America. Welcome.
Great to be here. Thanks for having me.
Savita, I wanted to ask you first off, why you think there's been so much interest in ESG investing over the past few years?
You know, I think it's a great question, and I think part of it is that people started to figure out that it works. And really, here we are is an environment where ESG investing has been a proven way to generate alpha. So a lot of our work, 5 or 6 years ago, focused on really trying to see whether these attributes actually added to company performance. I work on Wall Street, so what I write about is, how to generate excess returns for our institutional investor clients. And what we found was actually very encouraging in that, a lot of these non-financial attributes are actually more predictive and more powerful in signaling returns and risk than a lot of the things we learned about in Finance 101. And I think that's where we are in terms of the adoption of ESG and, these sort of non-financial signals as ways of selecting securities. I think also, just quickly, this isn't a new discipline. Investors since day one of investing have been thinking about governance risks, environmental risks. flight risks of top talent at companies. And now what we're doing is just sort of more formally integrating it into the investment discipline.
Now, I want to go back to an interesting point you made about how some of these leading ESG indicators, these so-called ESG red flags, could actually be more predictive of how a company or a stock does than some of the more traditional financial measures. And it's interesting because I think there's a perception that you could either target ESG or you could target profits. And I wanted to ask you which ESG factors and considerations appear to be the most important when it comes to a company's financial output?
Yeah, great question. And the answer is it depends. So what we found is that certain sectors have more material issues than others, and certain regions have more material issues than others. So for example, for companies within technology or biotech, companies that rely on really smart and innovative workforces, we've found that employee satisfaction, training, things that will guard against flight risk are really critical in terms of determining performance of a company relative to its competitors. For a company like financials, I think what was really interesting to me, having worked in the financial sector for almost, for over 20 years, ahead of the crisis, what we found were that a lot of the governance and social factors for banks started to deteriorate in 2005 to 2007, a couple of years before the financial crisis. So we found that governance was a very critical determinant of risk within the financial sector. And in hindsight, I wish I had been really focused on ESG back in 2005. For other sectors like energy or materials or capital-intensive sectors, we found that environmental concerns are more important. Safety of workforce, for healthcare product safety is a very important factor. So, it really depends on the business, but what we found in our quantitative and fundamental analysis is that the way to use ESG is specific to a sector. It's not that sort of one-size-fits-all type of strategy that might be used. So the devil is really in the details.
And when it comes to the details that investors are looking at, what are the main ESG categories that investors are most interested in?
So, I think that recently environmental factors have taken center stage. And this is because, the world has made a fairly aggressive commitment to getting to net zero within the next few decades. And the time is now. And I've heard others on your program talk about this, and I think this is really the critical issue. Now, today, I think the mechanics of getting to a lower greenhouse gas emissions world it's getting complicated. And what we're hearing from companies is that it might not be as easy as it seemed on first blush. So I think environmental factors, companies that have set targets to reduce emissions and are meeting those targets, because now we can actually track progress of companies. So it's interesting, a few years ago, everybody set targets. Now we can actually track their progress towards getting there. Governance, always important, but I think that's the most well understood part of E, S, and G. Social factors, I think, are really taking center stage now in light of this rampant labor inflation and a tight labor market. So when you think about, a happy, stable workforce, that might be paramount in today's environment where attracting and retaining talent is getting costlier and costlier. So, I think that the E, S, and G all have roles in the investment landscape, but probably today, environmental and social issues are really taking center stage.
Now, Savita, you just mentioned a wide range of issues that investors are looking into and interested in. But do you think they have enough information right now from companies to make informed decisions about where their money is going based on those factors and trying to follow a specific set of values based on those ESG factors too?
Yeah, it's such an important question because disclosure and transparency and being able to compare two companies on an apples-to-apples basis is really important. And I think that's where regulators are coming in and saying, okay, here are the things that every company needs to tell us as investors, and this is the way you need to show it to us. So I think that's really where the regulatory world is changing. And, you know, just on a daily basis, it's hard to keep up with the headlines around, you know, what various NGOs are proposing. But I do think we're in an environment where we need some type of standardized disclosure system so that we can make informed comparisons between companies. I think what's hard is that smaller companies don't necessarily have the resources to disclose as much information as a larger company with a specific ESG team. So that's where the challenges come in terms of helping companies understand how to disclose and maybe even helping them with the process and the resources involved in measuring and telling investors how they're doing. But, you know, to your point, I think the amount of information that we've seen over the last 5 years has been explosive in terms of what companies are telling us, because I think that companies realize that if they don't tell investors what we want to know, we're not necessarily going to assign the appropriate cost of capital to their stock or bond.
Savita, you brought up a point that I want to come back to, which is some concerns about whether smaller firms can actually hold up and, you know, comply with these disclosure requirements. That's something that's been mentioned by many policymakers and lawmakers in Washington who are concerned about these ESG disclosure rules, predominantly Republican lawmakers, but several industry groups too. And I was wondering how the SEC and other regulators should try to strike the balance between giving folks the information that they want and making sure companies are actually in a place to be able to provide it.
Yeah, I mean, I think it's a complicated problem, and you know, I think the issue is, I think that the solution might be aided immensely by coming up with a standard set of metrics. So similar to, you know, accounting standards. Every company that is publicly traded is on the hook for disclosing their financial information in a fairly formalized way, and I think that would be the model applied to certain components of ESG investing or ESG attributes. The problem is a lot of this stuff is fuzzy and hard to measure. So that's where the latitude comes in terms of giving companies, you know, some berth in terms of how they're measuring these factors. You know, even today, I think what's interesting is that corporates have really taken a leadership role in disclosure, even smaller companies. So we've seen, you know, even recent IPOs, companies have published corporate sustainability reports alongside their financial statements. And I think we're getting to a point where, you know, if investors want information enough, companies are going to figure out a way to give it to them. And that's really what we're seeing happen real time. But you know, one of the things that we see a lot is that ESG investors tend to have a very large company bias because that's where the disclosure is the strongest. And we fear that that's missing a lot of these great companies that just don't have the bandwidth to tell us how great they are. So I think that's something that we need to really thoughtfully figure out.
Savita, my last question for you is from our audience. It's from Mark Anderson, a senior government relations advisor at Kelly Dyer. Mark asks, how much should ESG factor into lending?
Into lending. So, you know, I think it's a really interesting question. And I mean, the question is, should green bonds even exist? Should labeled bonds even exist? I mean, the idea of carving out a certain portion of your capital as green or labeled is a little bit, you know, unsatisfying if you think about this from a more holistic and systematic perspective. But I do think that what we've seen is, you know, the trackability and the traceability of funds, the intention, the idea that if you issue this capital, it's additive to what you're already doing, and you couldn't have used cash in other places to fund these themes. I think that's where it becomes a really enriching source of lending and capital allocation. I mean, at the end of the day, I think we're going to get to a point 10 or 20 years from now where we don't talk about ESG. Everything is ESG. We think that we've incorporated all of these aspects into every bond that companies raise, into every practice they make, and it's just sort of firmly embedded in their operational expertise. Right. But you know, we're probably not there yet. So in that transition, you know, I think that the role of labeled bonds is a really critical source of capital.
Certainly. Thank you, Savita Subramanian, Head of ESG Research at Bank of America Global Research. I appreciate you taking the time.
Thank you. Great to be here.
And now for a deeper dive, I'd like to welcome our panelists. Andrew Behar is president of As You Sow, a shareholder advocacy organization. And Magali Delmas is professor of management at UCLA Institute of the Environment and the Anderson School of Management. Welcome to you both.
Thank you.
Now, I want to start off with a question for Andrew. You know, we've talked a lot today about the SEC disclosure requirements. I want to get a sense of what you think of when it comes to whether or not these requirements are laying the groundwork for more information for investors.
The new SEC climate disclosure rules really boil down to one word: trust. It's the SEC's core mission, is to establish trust between a company and its shareholders. And what this does is say, when you disclose material information, which is information that will have a financial impact, it needs to be accurate, verified, and in a standardized format in the audit. So to me, it's like the most basic thing the SEC could be doing, and that we need to have more of that, because a lot of the decisions that are made on whether you want to invest in a company, whether you want to hold, buy, or sell, really comes down to doing your analysis, and it's beyond just the financial metrics. You need to look at some of the other risk metrics that a company is facing, and those risk metrics are what the SEC is saying you need to make accurate. And the problem has been recently that a lot of the, particularly the greenhouse gas emissions data that companies have put out is misleading. And so it gets scraped by MSCI and by Sustainalytics and Refinitiv, and now you've got misleading data mixed in with all this other data, and what we need is good quality data.
Now, do you think the SEC's framework that they've proposed so far, you know, it's obviously still needs to be finalized. There will be a few challenges to that, which we could get to. But do you think the framework they've laid out could get us to that point where investors have that good data?
I think it's, frankly, not, didn't go quite far enough. They gave a safe harbor for companies who are disclosing misleading Scope 3 data. But overall, I think the idea that it needs to be verified by a third party, standardized in format, put in the audit, and that if it's misleading, just like if you had misleading financial information, that it could be challenged by shareholders. So I think we're on the right path. It could be a little stronger, but not a bad go at it.
Certainly. Now, Professor Delmas, I wanted to ask you a question about the database that you and your team at UCLA are working on to track and monitor these ESG disclosures. Tell me a little bit about what you're going to be paying the most attention to.
Well, first, I just wanted to agree. I agree with Andrew in terms of the reason why we're doing this database of ESG disclosure. It's because the current data isn't, as transparent, as we would like. It's often difficult to figure out what's behind these numbers. So we wanted to do this from a very transparent, academic process with scientific rigor. So what we're doing is collecting data on the, kind of the biggest companies, the Fortune 300 companies, and seeing what they disclose, how they disclose it. And what we find is that only half of them really kind of disclose comprehensively about, ESG. So that's, kind of, a beginning. But if you think about these companies that are the biggest, the most successful ones, that have the most resources, they're not disclosing as much as we would think. And what we've done is use the World Economic Forum framework, which is kind of based on the supposedly most used metrics. So right now, what the metrics we're really interested in are, of course, the environment and the social, elements. Governance and the other one, prosperity, are already kind of well developed, and I think we have a lot of information on that. But on the environment, we don't really. There are areas where we have almost no information. So greenhouse gas emission, we see a lot of reporting on Scope 1 and Scope 2, almost 80%. Scope 3, we kind of go back to really much lower numbers, 60% reporting. And then water, land use, we have very, very little information. On the social side, also, we get less than 20% of the companies we're looking at that are actually reporting, comprehensively information about social elements such as diversity, for example. And so our point is that, this is information that you have to report anyway to, kind of the governments. So it's not that difficult. So a lot of the time we have, companies saying it's going to be hard, we have to do a lot of work. But in fact, a lot of this information already is, gathered by companies.
Certainly. Now, a question for both of you is, this is a lot of information about a lot of different topics that companies are being expected to disclose and, will be mandated to disclose if these rules go through. But what is an investor supposed to do with all that information? What should someone who's, interested in ESG investing look for when it comes to breaking down and making sense of all of this information? Andrew, if you want to start off with that.
Sure. So essentially, you're looking at risk. That ESG just means risk. You're looking at environmental risk. So climate change is obviously one. There's other items. Social risk. It's really about retention of your best and your brightest of your workforce, which is, certainly a big metric that an investor would use to say, is this company going to succeed? Can you retain your workforce? How do you promote your workforce? And we actually have asked companies very specifically. We've written letters to 3,000 companies and been filing a great many shareholder resolutions asking companies to disclose their retention, promotion, and recruitment rates, and then cut them by gender, race, and ethnicity. Because the EEO-1, the Equal Employment Opportunity Form, which is required if you're going to be doing work for the government or if you're a certain size, it's really the very baseline. And we've now looked at 134 EEO-1s. We're actually coming out with a report in a couple of weeks about the EEO-1 data, what it shows, but it's very limited. For instance, looking at EEO-1 data, you cannot tell if there's a promotion gap for women. You could tell if there's, even if there's a wage gap. What we've seen in some McKinsey reports is that men and women entering the workforce at the same level, at the entry level, by the time you get to a senior vice president, it's about 88% men. So there's a promotion gap. EEO-1 will not show you that. It'll show you if there's people of color or women in the workforce, but they may all be at entry level jobs. So the companies know this information, and it's really about, can you disclose this? When will you disclose this to your shareholders so that they can use it to make their buy, sell, or hold decisions?
Certainly. And Professor Delmas, what do you think investors should do with this information and how they should be able to navigate it, when they're trying to make these decisions?
So I think it's just the beginning, scratching the surface of all of these metrics. And there'll be some trade-offs between, some of these elements. I think it's just the beginning for chief financial officers to realize what this does. The research is showing things like, yes, if you take, if you are good actors of within your community, within society, if you respond to your stakeholders, you're more likely to retain your employees. You are more likely maybe to kind of reduce your costs in terms of, the efficiency. You're more likely to reduce your risk. So all of these elements are kind of pointing in the right direction. But I think investors at this point are still not yet, and all of us are still not yet clear on what are kind of our priority within all of these different metrics. And I think we'll learn. But the first thing I think to learn is to have the data. And so far, we're trying to look at this information without really being able to compare, as the previous speaker was saying, apples to apples. So once we have all the apples lined up with all the oranges and everything, then we can start to think about this a little bit more systematically with information that we can trust and information that we can compare. So change, behavior change starts honestly first with knowledge. You know that there's a problem, you're able to evaluate the problem. And once you do that, or maybe you can control the problem. So what can you do about it? And this next step is, are you going to do it? Motivation. So we're just starting the beginning. What does this information tell us? What is the amount of a greenhouse gas emission that we have to deal with? What are all these kind of problems? What do they look like? that's kind of looking at the problem now. Next step is to look at, at solutions. What can we do about this? But without disclosure, we won't be able to even start, with the first step.
Certainly. So we've talked
and,
a
and
bit
sorry,
about... I'm sorry, go ahead.
Just yeah. And what I wanted to say is just not disclosure, it's mandated disclosure. I think it's really important that disclosure is mandated, so everyone has to provide the information. Because right now it's voluntary disclosure, so only some companies, those who maybe have more resources, but maybe also those that are doing better, that are disclosing. So we are not really able to evaluate the entire issue, the problem at stake.
If I could just jump in just to add on to that. So, for instance, when after the George Floyd murder, we were looking around saying, how do you evaluate companies on racial justice? And we didn't find any measures. So we actually created 57 key performance indicators of racial justice and diversity, equity, inclusion. And our research team went out and evaluated the Russell 1000, so 1,000 companies. And we were able to now to see who's a leader, who's a laggard. And we could sit down with a company and say, look, you scored a 5, your direct competitor scored a 35. And here's why. These are the 5 things they're doing you're not. And almost 100% of the companies thanked us for this. They said that the way that we were measuring them was really something that they could work with. And we withdrew, we filed these resolutions at 27 companies. Every company agreed that they needed to improve, and we withdrew all those resolutions. So none of them even went to a vote. But you can see that the companies understand that they want to create a culture that's going to attract the best and the brightest. And so the tools that we build help them to do that.
That's really interesting. Wow. Now we have another audience question for you. This is from Cristina De Concini, Director of Government Affairs at the World Resources Institute. Cristina asks, what do you make of the fact that Republicans on the Hill are targeting ESG and generating a lot of negative media about it with a great deal of misinformation?
I can go first if you like. I think that they are using those 3 letters for political gain without actually evaluating what it means. That what they're saying is we want more risk. We want the companies to have more risk. We want investors to have more risk. That if you're anti-ESG, then you're really saying you don't want companies to evaluate and take care of risk and to be more competitive. So they're saying that they want to invest in companies that are less competitive and are not addressing risk. It doesn't really make any investing sense at all.
Well, I think, as you know, we are in a bipolarized world where the environment and the kind of potential environmental regulation is going to be fought by the Republicans. So that's kind of where we are. But we're just asking, in this case, with the new SEC, disclosure, they're just asking for disclosure. It's just not even, reduction. Imagine. So we're kind of far from, the 70s where we had the Clean Air Act and, a bunch of regulations coming in. We're just asking information. And how would that be a problem to be transparent? So, I'm a big fan of information policies. We have examples, the Right to Know Act 1986 after the Bhopal, kind of catastrophe in India, where we said, as a community, as a citizen, you have the right to know what's happening in your backyard. And that's how the toxic release inventory started, where facilities have to disclose information about the toxic releases that they emit to the environment. And that is being, shown to be quite successful as a policy. There have been other examples in the electric utilities also that have kind of made big differences. So I think that we just need to kind of see about this where we are in terms of level. We're not asking reductions at this point. It's just to look at the kind of scope of the problem.
Definitely. I do want to acknowledge another SEC rule and this is about ESG fund naming. So as you saw, we evaluate 3,000 mutual funds every month on environmental, social, and governance issues, including private prisons, fossil fuels, deforestation. And we looked and we saw there's 94 funds that have ESG in their name. And we looked at them and noticed that 60 of them got a D or an F from us on ESG. And when we looked deeper and we had a team of data scientists do this analysis, and we brought all this data to the SEC actually, and what we noticed is that there's a lot of great ESG funds that have been there for 30 years, Trillium and Green Century and Parnassus and Pax, actually doing ESG. But the ones that were named, had ESG in their name, were Vanguard, BlackRock funds that had just changed their name but not changed their holdings because they wanted to be they wanted to get more investment. So BlackRock has a low carbon transition fund, for example, that got $1.25 billion the first day. It was a record. It's got Exxon, Chevron, Duke, Southern, pipeline companies, deforestation, weapons, private prisons. It's basically your extractive economy fund, but they call it low carbon, and people invest to reduce their risk from climate. And so the SEC just came out with a new fund naming rule just on May 25th that also addresses this problem. It's not an ESG problem, it's a labeling problem, and they're addressing the labeling. And so we're happy to see that as well.
Certainly, a lot to think about here.
Yeah.
And thank you so much for your perspectives. Many thanks to Andrew Behar, president of As You Sow, and Magali Delmas, professor of management at the UCLA Institute of the Environment. My next guest is Congressman John Rose, a Republican from Tennessee and a member of the House Financial Services Committee. My colleague Bob Cusack, our editor-in-chief, recently sat down with him. Let's have a listen.
Congressman Rose, thanks for joining us today.
Thank you, Mr. Cusack. Thanks for having me.
Oh, please call me Bob. Now, you spearheaded a bipartisan letter to the SEC regarding a regulation on ESG and climate change. Can you tell us a little bit about it and how it got going?
Well, so I serve on the Financial Services Committee, but I'm also a farmer. I have an operating farm. And so that when I saw this proposed rulemaking from the Securities and Exchange Commission and started to read into it and see the details, it really heightened my concern about how this would impact agriculture, particularly small farmers who would ultimately be reached by this rule. And so as I started to talk around with other members and with some of the organizations that represent agriculture, they shared that concern, and that's what really gave rise to us sending this letter, which is just really calling out the concern to the SEC that their proposed rulemaking could have vast unintended consequences, or perhaps intended consequences on small farmers all across this country.
You sent the letter in May, and you've asked for a response by June 24th. Have you received a response? And obviously, this is a pressing issue because it's an ongoing rulemaking.
We have not yet received a response, and I suspect that the SEC probably is being overwhelmed with comments. So if past example is any precedent for what we might see here, it could be some time before we get a response.
As far as the comment period, you want, because it's such a complicated rule, as government regulations are, you want the comment period extended. Is that right?
Well, absolutely. So initially, the SEC, I think, in a very unreasonable position, provided a very short comment period for a rule that is 510 pages in length and has 1,068 technical footnotes to it, and they provided just over a 30-day comment period. They have now extended it, but I think because of the stutter step there, it would be appropriate to provide from this juncture a full 90-day comment period so that stakeholders have the broadest possible opportunity to respond to what will be a very impactful rule if ultimately it goes into effect.
What kind of feedback have you gotten from your constituents on this, maybe farmers back home?
Sure. Well, very positive. I think to some extent, it's a wake-up call to farmers who don't spend every day poring over historically, in particular, the Securities and Exchange Commission rulemakings. Farmers are regulated by a raft of federal, state, and local agencies of one sort or another. They're not used to being regulated by the Securities and Exchange Commission. And frankly, I think the SEC has stepped over its bounds here by proposing a rule that would touch individual sole proprietor farmers all across this country.
And if this rule were to go in effect, how would it, in your view, affect the food supply chain?
Well, I think it will have a deterrent effect on the supply of food, and ultimately it will have a negative impact on the price, because I think anytime you burden agriculture and farmers in particular with more regulations, it's going to have a negative effect on their ability to supply food and fiber. As one of my friends says, when you've got plenty to eat, you have lots of problems, but when you're hungry, you've got one problem. Well, this is going to burden farmers who work from dawn to dusk every day, usually to produce. They don't have extensive staff, certainly don't have compliance departments that are toiling away, trying to figure out what sort of new federal regulations they need to comply with. So farmers are going to be asked to do this. It's going to take away from their core responsibilities and make it harder for them to make ends meet. And it's going to have other intended impacts that I think are going to be negative for the food supply. It will cause greater concentration of production, in my opinion, because farmers that are unable to meet this stringent requirement of providing this information are unable to do so. They're going to fall by the wayside. In fact, the rule itself suggests that the companies that are complying with the Scope 3 disclosures should seek out suppliers or customers who are better able to comply with these requirements that are being envisioned by the SEC.
As far as the rule, do you see merit in companies providing more information along these lines, and SEC has just gone too far in the scope of it, or are you concerned about the movement as well, maybe just going too far? It is a trendy kind of issue right now.
Right. Well, what I would say is I think this is beyond the scope of what the SEC is supposed to be doing. They're supposed to be making sure that we have marketplaces that protect investors. They're supposed to be encouraging the creation of capital and making sure that rules are followed. They're not supposed to be making up social policy or enforcing it, in my view. And so I think if this is to be done, it's the province of the Congress to take up these questions and decide if these are issues that merit further federal interference in the free enterprise system and further compliance by our businesses across the country, and not the place of the SEC that necessarily, I believe, number one, is going to be distracted from their core purposes that Congress did empower them to pursue. And number two, I think they're going to inundate investors, the very people that they are supposed to be trying to make sure have adequate information to make proper and competent judgments about the risk that they're taking. They're going to inundate them with a whole host of new information that in many cases may not really be material to the investment decisions that investors need to make. And so they're going to now have to wade through all of this ESG stuff, environmental disclosure that comes out of this rule, and try to sort through for themselves which of those disclosures are actually relevant for the companies that they're trying to make investment decisions about.
You mentioned the scope and the responsibilities of the SEC. I mean, do you think that if this rule is finalized, that it's going to end up in court as is?
Absolutely. And as an attorney, not a securities lawyer, by the way, but and I consider myself to be a recovering lawyer, but that these kinds of rules will just be a haven for the plaintiff's bar. They will want to test every nook and cranny of this new rule, and so we can expect a profound amount of litigation as we try to sort out the definitions, the meanings, the depth, the contours of this new rule. So it will be expensive for shareholders whose companies that they invest in are going to have to foot the bill for the legal challenges that will make their way through the courts. And ultimately, the fear of litigation, as we know, so often drives decisions in marketplaces by producers and market participants. And so you're going to see a lot of defensive moves made by companies to try to avoid being the test case, if you will. And so they're going to be incentivized to try to avoid that by maybe going above and beyond what even the SEC might have envisioned if this rule comes to be put in place. And so all of that is going to just be a immense regulatory burden on the industry at large, the investment community at large. And if it touches agriculture in the way that I anticipate, it will increase costs for farmers at the very smallest level across this country.
Was it hard? You got a lot of signatures on your letter, including Democrats, Congresswoman Luria, as well as Slotkin on there. Was it? And people forget that there are basically farms in every district. People think there's farmland and non-farmland, but was it hard, getting people to sign on to that? And especially in these polarizing times, you're able to get Democrats to sign on too.
Sure. And surprisingly, it was not. I think most members of Congress immediately, when you explain particularly the impact of the Scope 3 disclosures, they almost to a number start nodding their head and saying, oh yeah, that's a real problem. We can't let that happen. The SEC has gone beyond its mandate and is outside of its lane. Last question.
The way the midterms are looking and the way the president's job approval numbers are right now, very likely that the House will flip in November. Should the House flip and the administration doesn't bend, do you think there could be legislation looking to overturn this that the new House Republican majority would bring to the floor? Absolutely. I would expect that if this rule was to be implemented in anything akin to the way it's been proposed, I think you would see legislation to try to turn that back. Obviously, the question is whether the administration would allow that to happen and whether there would be the congressional will at the level of overturning administrative action. But I think ultimately you'll see this regulation, whether it be in the next Congress or in the next administration, whenever that time may come, you'll see this turned back. And one of the things that I would just reiterate is that, we go to the store shelves and we see no baby formula and we wonder, why did that happen? Well, it's misguided policies like the one that you see the SEC and Chairman Gensler advancing here that ultimately lead to these breakdowns in the free market and scarcity that seems to have no explanation sometimes. And so the folks listening need to know this overreach, this regulatory overreach is going to have profound and unintended consequences that will ripple out over time, that will make this economy less efficient, increase costs for everyone, and ultimately perhaps lead to levels of deprivation that we don't expect. Mm-hmm. Well, it's definitely a big regulation that's gotten a lot of attention and headlines. Congressman Rose, thanks for joining us today. Thank you for having me.
Thank you, Bob, and Congressman John Rose, Republican from Tennessee and a member of the House Financial Services Committee. My next guest served as chairman of the Securities and Exchange Commission from 2001 to 2003. Harvey Pitt is now the CEO of the consulting firm Calorama Partners. I spoke to him last week.
Harvey, thank you so much for joining us today. I want to kick off with a question about one of the biggest proposals the SEC is working on right now, which is the rules that they've laid out and proposed so investors have more information about a company or a fund and its potential impact on climate change. I want to know what you think investors deserve to know about how a company or an investment fund could affect carbon emissions or climate change in other ways.
First, let me say that the administration has made climate governance issues a matter of prime concern. As a result, all U.S. public companies are now affected by this dedication of the administration to these policies. And by definition, investors are going to be more interested in how companies respond to those issues. So I believe that many institutional investors have developed interests and concerns about comparing companies across a variety of criteria. It's hard to say you can compare, for example, an automobile company with a pipeline company, but the fact is that all companies have some impact on the environment, and that impact is growing. And there's a need for an orderly transition to required disclosures.
When it comes to making these disclosures and the kind of information that needs to come out, it's all more or less focused around the idea that climate change is a threat to the financial system. And investors need to know about where they put their money could be affected by that. How big of a threat to the financial system do you think climate change and the process of fighting it could be?
I think the process of climate change is important to the economy because as a result of the administration's policies, we're going to have to see companies step up and take responsibility for their carbon emissions, their impact on climate change. In addition, we have a lot of firms that are selling themselves as climate-related firms or environmentally satisfactory investments for people concerned about climate change. There needs to be some standardization of what people say so that investors can compare all companies and figure out where their limited investment dollars go. I think that means that the impact on the economy will be very significant.
How do you expect it to necessarily impact the economy? I know there's a lot that we, still don't know about how the rules that the SEC has proposed are going to firm up. But do you have any expectations about how investors are going to be responding to the different economic and environmental trends that are going on right now in terms of where they put their money in their investments?
Yes, I think that we're really dealing with a very different marketplace from the marketplace that existed when I first got started in the profession. Back in the late 60s, when I first began, I've been around, unfortunately, a long time. One of the things that we saw was that environmental issues were not really that significant. Over time, they have become much more significant to the point now where we have an administration that is pursuing a very aggressive climate change program. Investors largely are institutionalized today. The retail investor really invests in the market through a variety of mutual funds, pension funds, and the like. And those funds have demonstrated a great interest in climate change. As a result, many companies are now making disclosures. The problem, as the SEC has seen it, is that the disclosures are not necessarily consistent. So the SEC has suggested there's a need for a more uniform approach, although the fact that companies are engaged in different businesses means there's only so far you can go with a uniform approach. And the impact on the economy will be significant. Investors are entitled to know how their dollars are being utilized by companies and what policies companies have put in place to improve their status with respect to climate change.
And with all of that in mind, the United States is playing catch up in some regards to other countries and other, common partners that have moved the ball a little bit further in terms of disclosures about climate change, looking at their banks and financial institutions for how well equipped they are to handle climate-related financial risks. But in the United States, there is a good number of Republican lawmakers who think that climate change is not something that financial regulators should be focusing on specifically, or any more specifically than other relatively modern threats such as cybercrime and other hacking related issues. Do you think the SEC's focus on climate is appropriate given the broad array of different modern factors and threats that markets are facing right now?
As I've indicated, I think given the current position of the current administration, there is a need, at least, for companies to consider how those policies are affecting their operations. Where I think the SEC has had some difficulty is the fact that disclosures with respect to the environment should be required when information is financially material. That is, it's material to the company's financial well-being and outcome. What we have seen in some of the rules that the SEC has proposed are rules that go beyond that, rules that attempt to dictate what level of carbon emissions companies should disclose. That's not a function for the SEC. That is a function for the Environmental Protection Agency. And I believe the SEC is unfortunately overreaching to the extent that it is trying to do the job not only of its own agency, but of another agency that has far more expertise.
So with all of that in mind, what other questions and lack of clarity around issues in the ESG space do you think the SEC should be focused on? We've talked a bit about what companies should be disclosing, but what more do you think the SEC should do to make sure that investors know what they're getting when a fund brands itself as ESG friendly for one reason or another?
I think the SEC needs to look at what complementary actions are being taken by other agencies and entities in government. And the SEC can provide investors with meaningful disclosures. Its climate change proposals attempt to do that. I think some of the opposition to which you've referred is opposition that arises because the SEC may be going beyond that. So what the SEC needs to focus on is in what respects companies' engagement with climate-related matters can or does have a material financial impact on the company's bottom line. I think given that standard, what emanates out of the SEC will help investors, but not overburden public companies. And that's a delicate balance that I believe needs to be struck.
I've got one last question for you, Harvey, and this is more of a focus on what investors might be seeing in their day-to-day before these disclosures come out. What do you think is the end result of all of this new investor interest in funds that are specifically catered to not just financial returns, but their societal impact as well?
I think that those investors are looking for assistance from the SEC to have a greater degree of uniformity in terms of the types of disclosures that company makes, obviously leavened by the disparate nature of all companies and what their particular field of business is. We have seen companies tout themselves as climate-related or ESG-related superior investments. Some of those claims are exaggerated and might even qualify, as we used to say in Brooklyn, where I grew up, as fraudulent. So I believe there's a need for companies to take a closer look at what they're calling themselves, how they are living up to their nomenclature, and make sure that investors aren't being misled by how the company has named itself or how the company reports on its contributions to climate control issues.
Harvey Pitt, former SEC chairman, thank you so much for joining us today. I really enjoyed our conversation.
So did I, and thank you.
And that brings us to the end of our program today. Thanks again to Schneider Electric for their support of today's conversations, and thanks to all of you for watching. For those of you who missed any of the conversations this afternoon, we will have the video up from the event on our website shortly. Thanks for joining us.